Welcome in, everyone. It's Liam here with Golden Arch Investing, and today we're doing something a little bit different. We're going to be doing an article review, going through this article talking about a major market reversal that the author here thinks is likely coming in the near future. If this is something that interests you, please leave a like, subscribe to the channel. Would love to talk more, just sort of with you guys as a community. No script, just really getting the opportunity to talk about the markets a little bit. Now, I need to start this conversation here by saying Samuel Smith honestly does some really nice writing, has some really interesting points. He brings up some really interesting companies. He talks about things that a lot of people don't talk about. Absolutely nothing I'm saying today is supposed to make you think this guy doesn't know what he's talking about. However, I have my own opinions, and I'm sure you do too. And I really want to share my opinions because I think this article is a great opportunity to share with you guys a little bit about what I worry might be a trap a lot of us are looking into with the way the market's sort of going. How this video is going to go, pretty simple. I'm going to read through the article, going to give you guys my opinions, and at the end, I'm really going to talk about what I think we should be doing as investors with this kind of information. So let's start off. Obviously, he's saying a major market reversal is coming. He's talking about how dynamic the markets have been. And he's talking about two specific sectors that have rallied higher, specifically in sort of the most recent couple of months this year. He talks about a major reversal that he thinks is coming up, what it's going to look like, how to invest. If you're not aware, this is seekingalpha.com. I generally really like this site. I know you have to pay for it to have full access. I don't subscribe to any of the special communities on here, but I generally think a lot of interesting information, and you really do see a lot of people writing articles here. Yes, they're paywalled. Yes, that kind of sucks sometimes, but it gives you the opportunity to see just so many different opinions, and you can find some real gems on this website. Let's dig into this article. So he's talking about the dynamicism of the markets in the recent months, talking about increasing conviction, so people being more and more confident in their stocks, and then the announcement of the Federal Reserve's pivot towards cutting interest rates. For those of us that follow the markets, this has been the conversation for years now, is when's the Fed going to cut? Are they going to cut? Are they going to raise rates? Are they going to cut rates? What's going on? Honestly, it's almost been a year that people have been just salivating for Fed rate cuts because they're just waiting for this rally that's supposed to come. Talks about conflicting economic reports. That's something that's been really big in the news recently. We'll get a great report one day, a terrible report the next. Month to month, I'm talking about the American economy here because they're kind of the top dog. You'll see, great jobs report. And then you'll see tough jobless claims. And you're like, oh, are the Fed still going to cut? Are things still going to plan? Are things looking good? Is there a recession? Nobody knows. That's just the honest truth. Nobody has the answer. So people are in a sort of position where they're both very confident because things are going well, things have been going up, but also it's like they're ready to drop stocks at a moment's notice. And you'll see this if you're watching the SPY, if you're watching the Qs, things are up and down and up and down and up and down. We get the news back in August with the yen carry trade, and it's like a crazy day in the market. And then we almost forget about it by the end of the month. Anyway, so he talks lots and lots about how the economy, he believes it's probably on sound footing. But inflation might rebound if Fed cuts too aggressively, and that, on the other hand, it's potential that there might be a recession. He talks about how there's a lot of uncertainty, and that his conclusion from the uncertainty, from the way markets have reacted, is a coming major market reversal. So, to set the background here, he mentions a couple of things. First up, SCHD. If you don't know, this is sort of the it's a Schwab US Dividend Equity ETF. I would almost call this like the holy grail of dividend growth investing. It's an incredibly diversified US dividend equity ETF. They increase their dividends every single year. It's honestly a great investment if you're a dividend growth investor, and it's rallied. If you're looking at the screen here, you're seeing since the start of the summer, SCHD is up a total of 10%. And again, it's a dividend growth ETF. This is not the SPY. This is not the Qs. This is not something you expect to grow a huge amount in a few months, but it has. He breaks it down into some sectors. He talks about XLU, which is the utility sector ETF. Talks about VNQ, which is the real estate index fund ETF. And these are up even more. So XLU up 15%. VNQ is up 12.7, almost 12.8. Again, these aren't really things you'd expect to see. You don't expect to see these stocks going up so fast. And it's because they're recovering from the recent economic times. If you think about it, it makes a lot of sense that these specific sectors are doing so well. What do you need to run a REIT? Mortgages, debt. While rates are high, it's tough for these REITs to make money. If you've watched, REITs were a great buying opportunity not that long ago. Same idea with utilities. If you're a utility company, you're out here trying to build infrastructure. Again, you need debt. On the other hand, in the same sort of category of dividend stocks, we have BDCs, business development companies. Now, these guys are typically lenders, so their lives are getting better the higher interest rates are. And so, as interest rates finally have solidly started to come down, we're going to see some of these stocks go up, the REITs, the utilities, we're going to see the BDCs go down. That makes a lot of sense. Next up, he mentions the Qs. This is a chart just from September 9th showing the Qs are up 9%. The NASDAQ, the Qs, these are like big tech names, showing them up 9%. He mentions how there's strong jobs data, and apparently that's causing these utilities and REITs to cool off their most recent rally. He's talking about how the US 10 years recovered, but that mega cap tech is just going higher and higher. He mentions the AI rally, right? Huge trend over the last year. Big cap tech have been the winners for at least 2 years, at least since the sort of lows of 2022. Here's the kicker. However, one high yield sector that has been left behind during the recent rally is Midstream. All right, you might be wondering about Midstream. From my understanding, and again, I'm an Enbridge shareholder, so I think I have a good understanding. These companies are transporting raw materials, typically oil, from one spot to usually where it's produced to where it's exported or where it's refined or whatever. So this could be Enbridge taking the crude from the oil sands in the north of Alberta down to the coast. Could be Pembina, who we talked about in a video not that long ago, taking natural gas to the west coast of Canada. And he says that this sector specifically has been left behind. Why is he mentioning this sector specifically? Could be because of valuation. If you're looking at the chart on the screen, right, we're seeing basically no movement. Obviously, we've got lots of similarities between a midstream company and a utility. I mean, I'm pretty sure in my Enbridge video, I mentioned that they have a, and I quote, utility-like balance sheet, that they sort of run like a utility. And ironically, they own some utilities. So you might expect, hey, if utilities are going up, why are these guys not going up? Fair point, right? So he gives some reasons. Concerns about recession. Obviously, if you're producing oil or if you're taking that oil and selling it on, recession would be really bad for you. Just ask 2020. That was not a good time. Falling inflation So if you can charge less at the pump, then I guess you can charge less every step of the way. And how that's weighing on the energy sector. He says that Midstream should be the most resistant to such headwinds. They're not technically the guys who are selling it on to gas stations, refined oil products. They're not the guys that are paying to dig it out of the ground. They're just the middleman here. And that there's no real reason, he says, there's no real reason for concern about these guys. Okay. He says midstream companies have never had stronger balance sheets. Their balance sheets only continue to get stronger. Sounds pretty awesome to me. Obviously, that pretty vague statement. I'm not sure. I'm not sure if this is really the best time for all of these companies. It's pretty good for some. Some of them are looking a little bit more stressful. Obviously, it depends on the company. But he gives some examples that he shows. And honestly, first glance, all of them seem pretty great, right? Energy Transfer. This is a company I've wanted to talk about. I think these guys do a great job. And they've been repurchasing shares. MLPX has consistently bought back units. It's a slightly different thing. We'll talk about that in a moment. Enterprise Product Partners is doing the same. There's a couple others that say they might. Basically, they're able to give money back to investors, not necessarily in the form of a dividend, but in the form of a share repurchase. So they're purchasing more of the company themselves, taking those shares off the market, which means your ownership stake is increasing. And so now that he's sort of introduced this sector, he's talked about that they're undervalued. He says that there's some really strong names in the field. This is where we get to the reversal. He says that he believes the market is going to reverse its bullish stance on the Investico QQQ ETF, so the NASDAQ, in the near future. He says that because valuations are at nosebleed levels based on numerous metrics such as, mentions the Buffett indicator, the mean reversion model for the S&P 500, the S&P 500 price to earnings ratio model, and others. And basically because of this, these stocks can't stay overvalued forever. So he assumes they're going to come back down. That money's going to go somewhere, right? People are going to sell out of these companies. And if you're thinking about the size of some of these firms, if you're selling 10% of a $1 trillion company, you got $100 billion to allocate now. And that it's going to go somewhere. He thinks that the bullishness on utilities and REITs is warranted, but that same logic should be applied to these midstream companies because they have similar balance sheets. And he thinks that fresh money coming into the space seeking yield should be looking to these guys over utilities and REITs because they haven't gone up the same way that utilities and REITs have. Okay. I've got two things I want to say right here. Number one, I agree that these companies are probably undervalued based on how utilities and REITs have gone. I don't know that that means that a bunch of this money is necessarily going to go into these companies. There's a lot of reasons why people might not be putting their money into this sector right now. There's a lot of reasons why people might not be putting their money into these companies. Right? He mentions them up above. And they don't go away just because people are looking to put their money into something. If that was the case, then as people take their money out of treasuries, shouldn't these companies go up just like the utilities and REITs? Obviously, there's something that means these companies aren't worth the same to outside investors, to new money, as they are to current investors who think that they're equally valuable, equally attractive as a utility, as a REIT. Second, I don't think that just because valuations are high, that people who own the NASDAQ 100 are going to sell. I'm sorry, I just don't think that's the case. And even if they did, what's going to take these people, these big tech investors, and tell them, you know what you need? Yield. You should be looking for a dividend stock now. Now, in the case of an individual investor, maybe. Maybe this was their golden goose. They've made their or grown their portfolio to the size that it needs to be, and now they can grab some high yielding, fairly safe, balanced mix of stocks and just live off the dividend. That would be awesome. I seriously hope there are people out there who get to do that because of this rally in big tech. But that's not going to be everyone. And a lot of that money is going to be institutional. And it's going to be looking to make the same performance that it's made in the last 2 years. It's going to be a pretty tough sell if you're an institutional investor and you're going to your shareholders and saying, hey, I know we made 200% last year on NVIDIA, but this year we're going to make 7% in dividends on an oil pipeline. Like, just sort of letting that sit in the air for a second. I think these guys, these institutions, these investors that work for these big banks, that work for pension funds, that work for all these different funds, hedge funds, I don't know. I don't know that they're looking for this kind of stock necessarily. Obviously, as these big companies sell off, there's a lot of money to go around. I'm not saying that there's not going to be money coming into this sector. I'm just saying that I don't necessarily think it's going to be this big deal that these guys are looking for somewhere to sell, or that they'll sell at all. If they believe that this market can keep going, they might just hold. And we'll talk about this a little bit more sort of at the end of the video here. But I want to talk about his investor's takeaway, because this is what he thinks you should do based on what he believes will happen. Basically, he says that you should buy something like AMPL, which is a diversified ETF of master limited partnerships that own midstream companies. MLPs, it's a form of ownership where you get units in a partnership instead of shares in a company. Slightly different for tax reasons, but essentially it's just like a typical company, a typical share. Most big brokers will probably let you buy them. Maybe some not so much. If you're international, if you're Canadian like myself, might be kind of tough. And then there's going to be a little bit of tax implications for you. He says, on the contrary, if you're looking at investing in the C Corp space, so into like a typical company, a little bit tougher to find because some of these firms like TC, Williams, Enbridge, the company I own personally, Kinder Morgan, have all been bid up because people are optimistic. So again, like the utilities and the REITs, a lot of these companies have been bid up. And he says that, you know what, solid dividend payers, robust growth outlooks. If you look at them as basically utility, they're not overvalued. He says that the MLP space has the best opportunities in his opinion. And there's a few other specific stocks that he really likes. So again, Energy Transfer makes the list here. Would love to talk about them on the channel. Yeah. Anyways, he sort of reiterates his points here, makes a little bit of a conclusion, and then recommends that you join his a 2-week trial of his high yield investor community. Which, you know what, feel free to if you're interested. It looks like they're doing a 2-week trial. But I just want to sort of recap here and talk to you guys about my opinions. I have a couple things that I want to say, and I know I've said a good chunk of this already. People don't need to sell just because things are overvalued. First off, think about how many times you've looked at a company and said, wow, that thing's flying. There's no way. I mean, just think about NVIDIA. That thing was defying all expectations for almost a year. And I don't even know what the total percentage gain looks like, but it's ridiculous. Amazing. I had friends that owned like significant chunks of NVIDIA. I think I owned like a share or two, but you know, I'm patting myself on the back that I even participated in that rally at all, because that was incredible. Think about how markets have continued to rally even with all the uncertainty over the last year. And then think about the uncertainty in the first place. If we're out here asking ourselves, is a recession coming? If we're out here as investors asking ourselves if inflation's going to come back, and we're kind of trying to figure out where exactly we need to thread the needle between these two negative outcomes, that doesn't sound like what a top of a market rally sounds like. When you're nearing the top of a market rally, everything is bullish. Everybody's bullish all the time. Think about 2021. I know it's recent, but man, I remember it very well. Every tech company, every small cap, every pre-profit, I'm laughing, I'm sorry. Every pre-profit company was flying. Oh man, there's all these IPOs in the Canadian market that I just love to talk about because so many ideas that the market loved and they flew up and no one said anything negative. Not no one. Very few voices were really that negative on the market. And boom. All of a sudden, inflation's going up. Things are crashing down. And a lot of these companies are, these IPOs are private now. The small cap tech stocks, they've had a tough couple of years. And it was the big cap guys that were making money that turned out to be the real cash cows. So that's not really what the market feels like right now. Doesn't mean that this couldn't be a top, right? Tomorrow morning, the market might crash for all I know. But the point is that there's uncertainty. And when there's uncertainty, usually people aren't looking to sort of jump off the bandwagon. We're not usually looking to be at a top. Second thing, people don't change the way they invest just because things are overvalued. There's a great idiom that the market can stay irrational longer than you can stay solvent. And I think we should remember that as investors. The market does not need to make sense. Because at the end of the day, it's people. It's people that are buying things. It's guys at giant companies with gigantic amounts of money that are making the real market shifting decisions. Particularly when we're talking about something like the NASDAQ. This is tens of trillions of dollars managed by whole teams across different countries that are looking to make the most amount possible. I know I was kind of tongue-in-cheek before, but people don't become yield investors just because the NASDAQ's overvalued. Not big money. They're unlikely to bring that strategy shift to their firm. And so if we're looking as yield investors, we're looking for some money to come into any specific sector we're invested in, it's probably not going to be giant tech company money. That's probably not who we're going to get. We're much more likely, again, like I mentioned, to get somebody who's been investing, so a private investor who's been investing their money for years and years and years, who's owned these tech stocks, who's participated in the rally, who's managed to hold on to these shares for 10 plus years, and maybe they're done and they've made enough and they can retire and they can, they've hit their fire number, or their RRSP has hit the kind of numbers they need, and they can toss it into Enbridge. They can toss it into TC. They can make, some investments in MLPs, and they can sit back, enjoy the yield, live off the money, right? Like those kind of people, yeah, they're probably going to be looking for a deal. And this article, man, I hope they find it. But again, I don't think the big money is going to be shifting this way. The other thing I do want to mention briefly, I'm a Canadian investor. I think a good chunk of people who listen to this are Canadian investors. it's tough. It's tough for us to invest into MLPs, to deal with the tax consequences, to go through the hurdles. If we're investing in something like an RSP or a TFSA, to deal with the idea of eligible versus non-eligible dividends, right? Is this a dividend? Is it distribution? There's all sorts of stuff that goes on there. I think that it might be a tough sell for some of these people. But a lot of the companies he's talking about here are small enough that the amount of money coming out of big tech, the amount of money from individual investors could make a difference. And so if I look back on this, it's October 16th, 2024 right now as I record this. If I look back on this in 2 months, middle of December there, and I see that MLPs have just shot up, I should I should buy Samuel here a coffee and say thank you so much. You are amazing. Send him a gift. Join his group, because I think that would actually be probably a really interesting thing to do. But I don't necessarily know that's going to happen because of all of the points I've put out there. And at the end of the day, I think the biggest thing that I wanted to say to you guys today is please don't invest based on what you think other investors will do. That is not a good strategy. If you're going to trade, be a trader. Go take some courses and learn technical analysis and be a part of that community. And there are great traders out there. There are people I've watched make ridiculous amounts of money. Every time I do it, I lose everything. Well, not every time, but seriously, I am not the kind of guy that can sit there, that can look at a chart, that can catch a bottom and YOLO into 0 days to expiry SPY calls and make money off of it, right? That's not the kind of world I exist in. If that's you, if you can do that, if you can figure out the psychology of other people, figure out what they're going to do, you can predict their actions, man, you can be rich. If you can consistently do that, even just above a 50%, and you can consistently make a little bit of money every time, 2 step forwards, 1 step back, wow, you're going to do great. I can't do that. I don't have that skill. And if I did do that, I don't think what I'd be doing is trying to take valuation into account and guess what the market's going to do based on valuation. Because again, markets are irrational. It's a lot of people trying to figure out what other people will pay them. And so it doesn't always make sense. It does not always follow the rules. And while long term, the numbers really, really matter, short term, it could do anything. With all that being said, I know this is a longer video. I know it's a different format than you're used to from me. But please, hit that comment section down below. I would love to hear from you guys. What do you think? Are you going to be digging into the world of MLPs? If you are, I would love to hear about it. I'm super interested. There's lots of companies out there. He's right. There are companies out there that are undervalued. And we should probably, as investors, be buying them regardless of what other people think. Because if we're investors that are looking for yield, hey, there it is. At a discount. Awesome. Amazing. And if you think that maybe I'm totally misreading this, I'd love to hear that too. If you got a totally different take, if you think that actually a lot of people are going to be looking for this exact kind of stock and that you can play this kind of trend, I'd love to hear about it. With all that being said, folks, that's all I have for you today. Please leave a like on the video. If you're interested in stuff like this, subscribe to the channel. We've got a couple of videos coming up in the near future. I think it will really interest you guys, sort of in our normal video explainer format. With all that being said, catch you in the next one.